Hey, welcome back, everybody. And guess what? Believe it or not, home prices is creating an issue or are creating an issue for buyers out there. That's not new, but our market is, we're looking at a few things in the future that might ease part of that pain. We're going to talk a little bit about the November end metrics and how we finished out the month. What do we expect for December? And then, of course, another video will be what to anticipate in 2025. In the meantime, let's get the show on. Okay, so remember, we do create shorts so that if there's any of these segments that you want to view in a shorter version, make sure you go and check out the shorts. Keeps it super simple. This does a real deep dive consistently, and we evaluate the metrics each week, residential only. Some of the numbers you're going to see today, well, those numbers are based on the entire Northwest MLS, including condos, manufactured homes, all listings that came on. So our numbers are a little bit different when we talk about sales and velocity and absorption rates and things like that, because we're only dealing with single family only. Each week, single family metrics only. So a month end, sometimes like today, you're going to see a few different numbers, but don't panic. Just saying. All right. So when we take a look at this, the Northwest MLS put out, it says persistently high prices put a strain on the market. And moreover, it says seasonal slowdown of our real estate market has begun. However, the market still shows signs of improvement year over year with a 23.4% increase in active listings and an increase of 24.7% in closed sales. Okay, the missing piece of the equation for potential buyers is affordability, with the median sales price increasing, basically 7%, and that's going to be a big deal for a lot of buyers out there. Now, understand, we are one of the 5 sweet spots across the United States. Okay, our economy, our real estate market, and everything else is moving very well, moving ahead as it should, as a lot of the United States is. Now, granted, there are some channels out there saying there's some doom and gloom that's happening, but we're not in Texas, we're not in Florida, we're not in Detroit, we're not in some of those areas that tend to, let's just say, take that initial hit first. And even then, those markets actually are still doing quite well. All right, so if we take a look a little bit deeper, and we dive into what what we will call the key takeaways for November, according to the Northwest Multiple Listing Service, also called the MLS, the total number of homes sales increased year over year. So actually, I should say the number of homes for sale increased year over year. And that's a given. And we've seen that consistently each and every week. Some areas have seen a double digit, just like King, Snohomish, Pierce County, the 3 main counties that we take a look at. But there's also an increase of 24.7% when compared to November of 2023 to 2024 as far as actual closed sales. The total dollar volume had an increase of about 31.7%. That's actual total volume of sales. Again, that's including residential, including condos. That one doesn't seem to include vacant land, excuse me, but it will include manufactured homes. So let's get back to it. It says, although the median price slightly decreased 0.77%, not 1%, in October of 2024, but in November, prices increased year by year by 7.3%. All right. So again, it is seasonally normal for us to see certain things. Interest rates are going to have a massive impact on the real estate market. And probably one of the biggest impacts on real estate is the interest rate for mortgages. Now, understand, the Feds are going to be meeting in December again. No, I do not expect them to drop rate. I expect them to stay the same. Remember, the Feds only change rates one time every 6 weeks. Okay? They control when you get a car loan, they control that interest rate. When you have a credit card, they control that interest rate. If you have a home equity line of credit, also known as a HELOC, they will control that interest rate. Those are all short term. And in fact, they control what banks lend to each other on a daily basis and commercial lending. That has nothing to do with mortgage rates. Mortgage rates change every hour, every minute. They're publicly traded and banks adjust depending on what their profit is going to be. So if we actually take a look at what rates do versus what home buying does, well, first let's start off with our news, and it says here, mortgage purchase demand continues surging. Well, sort of. We're going to go into that. Down below that on the left-hand side, latest home price numbers, including a conforming loan limit. And we discussed part of that last week. We'll go over it this week. And of course, as we can see, 30-year mortgages actually started coming down from what we have seen in prior weeks. And you might say, George, what the heck? And I said, hey, remember, pay attention to Wednesdays. Wednesdays, we got okay news, right? As far as jobless, jobless applications, things like that, which is a key metric that the Feds look at. What's the employment rate? And that didn't come in as nice as what they had wanted, kind of as predicted, but that still then gave us some leeway, and then rates actually started coming down when we had been heading in an upward trend, pretty much since the Feds did their quarter rate drop, and of course then the half rate drop, in which we will go over that in a little bit. So if we open this back up, remember, bottom right hand corner, you have access to free mortgage calculators where you're doing one, or like this one, you can do up to three, and they allow you to balance, hey, which one is a good option? I can do a refinance and things like that. All right, housing. Mortgage purchase demand continues surging, well, kind of, sort of. And as you can see that chart, we actually start taking a look at what the volume is. And each one of those peaks, guess what? That's right. That's when we started to see an interest rate movement, as we saw here. This happens to be the refi index. And why is that important? Refi index actually is a pretty good metric as to when are people willing to make a change, whether it's a cash out refi or, hey, I'm going to reduce my rate. And you can see in 2020, that refi, when we were in the 3 percentile rate, man, it was off the chart, right? And then you have to wonder, okay, well, did real estate match that? We're going to get into that to a second. And as you can see, as interest rates started to change, right, they went to 5%, boom, immediately that refi desire, well, it basically, almost cut in half, right? And then when it went to 8%, it went down to a floor, bobbled along. Then as rates went back down again, all of a sudden, this year, before the Feds did their half rate cut, when we were at 6.02, boop, we saw that small little blurb or burp of refis, because they hit a lower rate than the 7.25 that a lot of other people had been seeing. So they saw that 1% rate change, and they went ahead and made that adjustment, which is a good move. Now, if we open that back up again, let's take a look at home purchase index. Well, lo and behold, looky there. 2020, look at that. The home purchase index was off the chart when we were at the 3%, right? Then that started to wane a little bit as we got into 21, 22. As you can see, we were hitting the fives, and then all of a sudden it started really falling off when, they went to the mid to high sevens, hit the low 8, mostly low 7s. And then all of a sudden we started seeing a little bit more activity again when we take a look at 2024, which is about, close to where we've been as far as slower markets. But if we go back to, 2019, you would see us actually closer into about the 225, 240 number there. That's million. And that gives you an idea of what people are looking at, what people are doing as far as home changes and things like that. That's our index. Now, if we look at them side by side, you can clearly see that the mortgage rate index, which is, where we're just happening to include the what we call the refinance rate index, you can see the two of them follow each other very closely, which is a given. That it is almost always how it happens. The next biggest one that comes into play, really at the end of the day, is how much inventory do we have out there, and what is the jobless, what is the job or the employment security level at, which tells people, hey, is it a good time for me to buy a home, or do I limit that risk and I'll just continue renting? And that's a big number that people look at. And as you can see, they follow each other very, very close, which then, if we pull up Freddie Mac and we talk about rate, as we saw that increase, here we go again. Nice. See that? You got to like that. Rates are heading back down. We started seeing more activity. Our running 7-day average for Freddie Mac is 6.69%. And that's lower than the bong where we were hitting next to the sevens. And basically, we're about a third of a rate below where we were at last year at this time. Because last year at this time, we actually saw a lot of rates coming down. That's why you saw that surge of buying at the end of 2023, because rates came down in October. Rates came down, buyers came out, inventory started to flatten out. We saw some pretty aggressive activity, and then seasonally normal, we started backing off in December. This year, we'll probably see the same thing again, with the expectation that in 2025, Q1, Q2, we'll probably see 5 3/4 rate for mortgages. So it's going to be low sixes, high fives, and we're going to see, I think, a lot of buyers coming out into the market that have been kind of sitting on the sidelines. And I think that's going to have a significant impact on our inventory level that, sometimes a little bit lower. Let me open up this chart. So again, we went through this last week. This is super important for a lot of you. Conforming rates now, well, I guess in 2025, is going to be now 806 instead of 740 and some change. And then, of course, we've got the single unit, what we call the high balance. That is $1,037,000. And again, that's based on income and housing values, and they adjust that every single year to each community. So King, Pierce, and Snohomish County will have these, but Chelan County or Kitsap, Island County, those numbers might be a little bit different. So this is not a guarantee through nationwide or even Washington statewide. This is more of county specific. So remember that. All right. So as we pop over, let's take a look at what we're talking about as far as average days on market for December. We've already seen that increase, which is not unexpected, right? People's mindsets now are starting to change. They're getting into the holidays, pulling back. Weather's not as nice. Market time is increased by 8 days over what it was last year. Again, situation normal. Taking a look at the list to sales price. List to sales price is still spot on. Okay, we're between 96, 97% of actual list price. So to keep it simple, $100,000 piece of property. If it sells for $97,000, that would be 97% of list price. Sold for $96,000, which is our metric there. It shows that for a home listed at $100,000, we listed or sold it at $96,000. Okay, or a 96%, list to sales price. Okay, pretty consistent during the spring and summer. We'll bop up 98, 99. Last couple of years, we went up to 103. But that was unique because interest rates were so low. All right, moving on. So if we come back here and we take a look at the Northwest MLS and we take a look at residential only, here we go. So get a load of this. We have 648 homes that came on market. That's actually a lot more than I expected. I was actually anticipating something closer to about the 400s. The however is, I was a little surprised by that one. Pendants are spot on. Those are basically 900 when actually pended. And then, of course, our solds are following exactly with that, with 780, let's call it 800 homes. But look at that middle chart. we have basically a lot more price reductions. Sellers say, hey, listen, I want to get my home sold. That bumped up to about 522. We call that an opportunity. Now, for all of the move-up buyers or even first-time home buyers that are out there, understand those are called opportunities, because the sellers in the winter months, really between the end of Turkey Day all the way through the end of January, for a buyer, that is the best time to buy a home. That is when I buy a home, because sellers are most negotiable during that timeline. Sorry, sellers. The however is the sellers are going to see a lot fewer listings. They're going to see more days on market. And by doing so, become a little bit more anxious, a little more motivated, a little bit more flexible to get their home sold. Those are real sellers. For buyers out there, the people that are on the market right now, those are real. And you should have a real conversation with them, because that is your greatest opportunity, and reduced you get reduced competition. In fact, many of the buyers that we are working with, we are consistently telling them, look now. Why? Is the most flexible time you will have with the seller. Sorry, sellers. All right, just saying. All right, so if we move on to our next chart, before, let's do this. Remember to like the video. Hey, here's the funny thing. 96.8% of all of the views are from non-subscribers. Subscribe if you would. If you like to get super accurate information, like the videos and leave us a comment. I'd love to hear what you guys have to say. All right, moving on. Let's talk a little bit about the metrics and the velocity of the Northwest MLS. Okay, when we talk about this, we're taking a look at a difference of an average sold price year to date of $66,000. And, when we look at it year over year, that's a pretty healthy chunk. And that just tells us that our market is absolutely moving right along. When we take a look at an average sales price for the month of November, okay, let's open this up a little bit bigger. For the month of November, month over month, look at that, 828,000 versus 784. Year to date, we're basically the same numbers as where we were at last year. So 842 for our sales price, 958 for an average list price. And the reason that that's important is we're seeing that consistency. We're seeing the metrics being level. We're not seeing huge, massive disparity. No different than when we take a look at our next chart here. Hang on a second here. When we take a look at the numbers as far as actual homes on market versus actual homes going off market, it's an impressive thing, because we are very well balanced. We're seeing a lot of health. We're seeing more pending sales. We're seeing more sales, and our actual overall inventory hasn't changed a ton. I mean, for the 3,000 additional pending year to date, the 2,700 additional closed homes year over year, and the 2,900 actual homes that are new on market, those numbers are right in line. We're not seeing crazy swings like what we did in 2020, where we had dropped down to like 2,400 total homes throughout the Northwest MLS. That was crazy. We're still only about 50%. We're about half the inventory where we were in 2019 and 2018. All right. So it's not like our numbers are, we're spot on. No, we're still low, but we are really the new norm, where 2 months of inventory is really where we need to be for our balanced market, not the 4 to 6 months that we historically have seen, in the prior 30 years. But we haven't seen those numbers really in the last decade, the last 10 years. We haven't seen those numbers. All right, hang on. Let's pull this back up again. When we take a look at the month of November alone, look, we got some great numbers here, okay? Even though we had, 20, I rounded these numbers, right? About 2,500 homes additional, had 120 more new homes that came on market than a year ago, 500 more sales than we had a year ago, and 1,000 more pending than we had a year ago, all right? Now, again, none of those numbers are crazy. They are consistent with what we've been seeing with lower interest rates. Now, had we popped back up into the mid sevens, high sevens, eights, we wouldn't see that. We would see what we saw last year, where sales were really struggling, okay? And affordability was even worse. But because we have been seeing in the sixes, situation normal, and low sixes, really awesome, that's why we've seen more sales, which is, again, consistent, but we're not seeing craziness out there, right? Okay, so if we pop over, we take a look at new construction. Now, this is going to be a little bit different, and it's going to be super interesting. So new construction, last year, we saw that surge. As you can see the circle, and you can see the blue line. The blue line is new on market, and as you saw, that goes down. That's situation normal. The red line are what has gone as far as pended, and you saw that took an uptick. Oh my gosh, normally it goes down. We saw an uptick in October, November, December, and then it's been pretty straight, pretty normal all the way through. Why? Because interest rates came down, and that is a big deal. Again, when we take a look at the prior chart, you can see interest rates go down, refi volume, mortgage volume goes up, real estate volume goes up. Interest rates go up, they come down, right? They're directly inverse of each other most of the time, all right? So when we take a look at what is going on the right-hand side of this chart, it says, okay, here, now we have incentives. What are you talking about? Incentives on the other side, mortgage rate change. Whoa, what? Okay, super, super simple. With interest rates being lower, we've seen more resale homes. We've seen homes, as you just saw in the prior slides, people who are taking their home that they've lived in, a resale, and putting it on the market. Whereas before, they weren't doing that. And the builders were absolutely capitalizing on that, okay? Because, we were at a third of the inventory level. But then when interest rates started coming down, people started putting their homes on the market. Then all of a sudden, people started to deviate from new construction. They didn't pay that 10% premium, moved over, and actually started getting homes closer to where they work and more in the areas that they wanted to be. They don't have to drive as far. They have more options, okay? And that is what we're seeing here. But because interest rates were already lower, they had to offer incentives, okay? Incentives would be upgrades, buying down a rate, buying down a permanent rate, maybe giving you better pricing on premium lots that were out there. There was a lot of different incentives being offered, including right now. In fact, right now, without a doubt, is the best time to buy new construction. Hands down, right now, best time to buy new construction. More incentives. You're going to get a lot more flexibility, and they're just not going to play as hard of hardball, and so you can get a lot of things. Now, you're not going to see but a nominal price difference, and that is because they need to maintain plat pricing and plat integrity, okay? Not only for you, but the people who have bought and the people who will buy. But I'll tell you, man, you can absolutely pack that stocking full of goodness in new construction. Just make sure you're working with somebody who understands that. And don't think if you go to the this is funny. Some people think that they can go to the site and they get the best deal. That's not how that works. I hate to break it to you, but that's just the way it is. Some people think, I'll save all of this money over here. No, the builder's going to save that money. They're still going to offer you some incentives. They're not going to offer you everything else that you could negotiate otherwise. Just saying. All right. When we take a look at some of the incentives that are being offered, look at this. 3.875 or an actual, 5.92 APR for the first year rate, and then it converts to a fixed, it is a fixed mortgage, but anyway, it's a 2-1 buy down. It still stays fixed. It's just for the first couple of years, or at least your first year, you're going to get a super great rate. The second year is probably 4.875. It goes up by 1, and then will be probably 5.92, basically just shy of 6%. Other incentives that you see out there, including credits, buyer bonuses, and things like that. Again, it's just another opportunity. When you take a look at this, we talk about what is the pricing difference? What the heck is going on? What are we looking at for velocity and whatnot? So if we take a look at this, year to date, pricing is up 3.5%, which I was actually kind of surprised. I expected it to be just closer to about the 900,000. It did bop up to the 912. When we take a look at the month of November, Year over year, there was, not quite 1%. Basically, it was a $7,000 difference, which is not monumental. A lot of these numbers are being brought down because of the project that is going up in Snohomish, because this is Northwest MLS wide, which is 3/4 of Washington State. Marysville has a couple of big projects up there, like 200 homes, 300 homes, something like that. And their pricing is significantly lower, which is having an impact just on a global level, as far as pricing. So with that being said, our numbers actually are a little bit better, minus we're being forced down by that project, those two projects. Anyway, with that, when we take a look at new construction as far as actual volume, hey, you know what? They're actually doing pretty good. All things considered, here you go. In fact, let's pull that up one more time for you. Here we go. So the year to date, we only have 394 more homes that are on market than it was last year. Yeah, pretty much peanuts. We're off 176 homes as far as actual solds, actual pended. Year to date, we're only 11 homes off. And again, those are pretty small numbers. When we take a look at November, though, you can see, heck, man, we were 28% higher as far as actual pended, 147 homes. So we, as it predicted and as we went through, we see that those numbers actually went really well, meaning that the incentives worked as predicted. They got 147 more homes than they did last year, which was super important. And last year for new construction, they were rocking, right? Interest rates came down, they were rocking. Okay. Then, we're about 86 homes actual sold more. Again, that's very well, because last year at this time, the builders were rocking because interest rates had come down, and that was a massive incentive. All right. So if we move on to, yes, the all-time favorite, bank-owned homes. Real estate owned is what that stands for. All right. Real estate owned still, it's just not very exciting. Let's blow the chart up for you. As you can see, it's pretty much the steady Eddie. We do not have much inventory at all. We do have our wall of shame, which is still about 10 homes instead of 12. You can see that, for the same month, okay, our inventory was down 17%. Again, not abnormal, but yet we still had more sales, more pended. When we take a look at the lower chart there, average days on market, that was 68 days. Again, 20 days longer than just a regular single family home. And here's the thing. Again, remember, REOs in our area they're just not a great investment. If you're holding off saying, I want a good deal, that's not going to happen. And the reason that's not going to happen is because banks know, one, we are, again, one of the 5 sweet spots across the United States. 1. 2, they know that we have limited inventory, and therefore they can do paint, carpet, vinyl, and they can get their home sold. 3, they know their home is going to sell at market value regardless, even though they will many times start above that, because they have to prove to the investor that they tried to get a better price, and it ends up selling at market value. So there's no real incentive. If you really want to take a look at other options, take a look at off-market homes. Okay, sellers that said, yes, I want to sell my home, but no, I don't want to go in the Northwest MLS. That's one option. 2, look at fixers. Fixers are a great opportunity, but not distressed fixers. Folks that just say, you know what, I'm willing to discount my home a little bit because I just don't want to deal with it. I want to move on. I want to do whatever else I'm going to do. You do it. And they are willing to do that. Just understand that, sellers understand that there's a lesser price to make that happen, but many times it fits their needs for what they want to do. Okay. If you have any questions, post it down below. Remember to like and subscribe. Smash that like button for me. Let us know that you enjoy it. Leave some questions. And it is a very rainy day out there. So make sure that you're staying dry. In the meantime, I'll see you on the next video, and you have an absolute beautiful day. Merry Christmas to you and your family. All the best. Take care.